Within a span of 60 minutes, gold declined by nearly $500 per ounce. Silver erased more than 10% of its value, and over $6 trillion in aggregate market capitalization vanished. There was no outbreak of war, no banking crisis, and no extraordinary event announced in advance. Yet the US dollar index surged sharply, US Treasury yields abruptly reversed course, and forced liquidation orders emerged almost simultaneously. For those who closely monitored markets in December 2025, this pattern is anything but unfamiliar. The central question is whether this episode represents nothing more than a technical liquidation, or whether it signals the opening act of a much larger cycle. In the aftermath of the plunge, the most important question is not how much gold and silver fell, but why the market reacted with such speed and uniformity. In less than 1 hour, gold lost approximately $500 per ounce, while silver declined by more than $13, equivalent to over 10% of its value. For many investors, volatility of this magnitude is typically associated with systemic crises. Yet this time, it unfolded on a day when surface-level information flows showed virtually no major disruption. This discrepancy alone compels us to look elsewhere. Transaction data indicate that the initial impulse did not originate within the precious metals market itself, but rather from foreign exchange markets, where the US dollar strengthened rapidly against major currencies. When the dollar's strength accelerates within a compressed time window, gold and silver tend to respond almost instantaneously. This relationship is well established, but the intensity of the reaction in this instance points to capital flows of substantial scale operating beneath the surface. Within the global financial system, gold and silver are denominated in US dollars. When the dollar appreciates sharply, the nominal prices of precious metals must adjust to reflect a new purchasing power equilibrium. Crucially, this adjustment process does not require negative headlines. It requires only a sufficiently forceful shift in the monetary balance. When such a shift occurs faster than the reaction capacity of individual investors, the market transitions into a different operating regime. Trading ceases to be driven by expectations or discretionary analysis and becomes governed by obligation. Leveraged positions face margin pressure. Technical stop-loss thresholds, often clustered around familiar price zones, are triggered nearly simultaneously. Prices begin to cascade, not because market participants collectively revise their outlooks, but because their ability to choose is removed. Within this framework, silver's more violent response relative to gold is entirely predictable. Unlike gold, which functions primarily as a monetary and defensive asset, silver remains deeply embedded in the industrial production cycle. Industry data indicate that more than half of global silver demand originates from sectors such as electronics, solar energy, and industrial manufacturing. As recent production indicators from China continue to signal deceleration, concerns over industrial demand add a secondary layer of pressure, amplifying silver's downside volatility. However, limiting the analysis to short-term supply and demand dynamics would render the broader picture incomplete. This sell-off occurred against a backdrop of heightened global sensitivity to monetary policy expectations. In the weeks preceding the move, signals from the United States suggested that a restrictive policy stance could persist longer than previously anticipated. A prolonged high-rate environment enhances the short-term attractiveness of dollar-denominated assets, particularly for international capital seeking yield. When yield expectations shift, capital reallocates. It does not remain static. During this repositioning process, markets most sensitive to currency dynamics are often the first to react. Precious metals occupy precisely such a position. This explains why the decline was rapid and concentrated, rather than distributed gradually across multiple trading sessions. At this juncture, timing becomes a notable factor. Price behavior, market psychology, and the response patterns of financial media during this episode exhibit marked similarities to conditions observed at the end of the previous year. At that time, a sharp correction emerged amid elevated optimism, only to precede a powerful upward phase. While this parallel is insufficient to justify definitive conclusions, It is sufficient to raise a legitimate question. Is the market replaying a familiar cyclical pattern or transitioning into an entirely new phase? Historical precedent suggests that within long-term uptrends for gold and silver, sharp declines rarely mark the termination of the trend. More often, they signify a transfer of ownership. Emotion-driven participants exit under duress, while longer horizon capital begins to accumulate near peak selling pressure. This observation is not speculative. It is a recurring characteristic across multiple historical financial cycles. More importantly, the structural fundamentals remain intact. Issues surrounding fiscal sustainability, global monetary policy frameworks, reserve diversification, and the role of defensive assets do not disappear because of a single volatile trading hour. These forces evolve more slowly than prices, yet they exert decisive influence over extended time horizons. It is therefore necessary to clarify the purpose of this analysis. The objective is neither to offer investment advice nor to predict outcomes with certainty. Rather, it is to illuminate the mechanisms driving market behavior during periods of stress, allowing observers to detach from short-term price movements and focus on a more consequential inquiry. What is changing at the structural level, and what remains unchanged? From an analytical standpoint, this sell-off underscores an increasingly pronounced feature of modern markets: speed. Capital moves faster, reacts more aggressively, and amplifies sentiment more intensely than in previous cycles. This accelerates corrections, but it also forces the market's underlying dynamics to surface more quickly. Rapid price movement compels participants to reveal their degree of preparedness. The divergence of interpretations following the decline is therefore inevitable. Some view the move as a warning of deeper correction ahead. Others regard it as a necessary rebalancing within an intact, broader trend. Both interpretations possess internal coherence, and their coexistence is precisely what generates liquidity, price discovery, and sustained market discourse. The essential task is not to choose a side, but to understand the analytical lens being applied. Short-term dollar fluctuations, cross-currency transmission effects, or the long-term function of gold and silver as defensive assets amid rising global uncertainty. When the question is framed correctly, observers are less susceptible to transient fear and better positioned to assess market developments with clarity. At this point, the narrative extends beyond a simple price decline. It becomes an invitation to reflection. What does this volatility represent? A temporary technical dislocation, or a familiar stress test within a broader financial cycle? Consensus is not required, but asking the correct question shapes how each observer interprets what follows. This leads to a critical insight frequently overlooked. The recent decline does not signify intrinsic weakness in gold or silver. Instead, it exposes how the global monetary system responds when shifts occur in the balance of monetary power. Volatility arises not solely from price movements, but from the interaction between the US dollar, economic policy, and confidence in long-term purchasing power. Viewed through the lens of monetary history, periods of political and fiscal instability are consistently accompanied by a renewed search for value anchors. Gold and silver are not instruments of short-term profit maximization. They are mechanisms for preserving purchasing power over time. This is why they repeatedly return to the center of attention whenever the financial order is tested. Looking ahead, the key variables to monitor are the rebalancing of monetary policy expectations and global capital flows in the months to come. These signals rarely emerge within a single session, but by the time they become evident, markets often have already adjusted. This episode may represent only the opening phase of a broader reassessment of defensive assets. How this shift will ultimately affect the US dollar, gold, and silver remains an open question. This is Money Cycles, where we examine the foundational forces operating beneath market movements. If you wish to continue following analyses of this nature, you know where to find us. Because within major cycles, the most important skill is not reacting the fastest, but understanding the dynamics most accurately.